We have two people here. We have three people joining virtually. And our moderator for this session is Irene Koch, an Executive Director with JP Morgan Asset Management. Before I hand over to Irene, just a reminder, you can and are encouraged to ask questions of the panelists. You can do that just by scanning the QR codes on the cards on the desks there, and the panel moderators will look at those questions as they come in. Irene, over to you.
Yeah. Hi, thank you. Thanks, Tim. Hello, everyone. Good afternoon. It's good to see a lot of people here on the floor. My name is Irene Koch. I'm a portfolio manager with the private equity group, the private equity fund of funds arm of JP Morgan Asset Management. So we manage about 28 billion in assets under management in private equity globally. And for ourselves, we do funds investments, secondary investments, and co-investments in the region. And here with me, I have four panelists here to discuss with you on the topic of due diligence. And before we start on this exciting topic, I would like to ask each of the panelists to give a brief introduction to themselves and also their firm. So Carl, you go first.
Thank you, Irene. I'm the lucky one who gets to sit up here today with Irene, so the rest of my panelists are with us virtually. My name is Kyle Shaw. I'm the founder and managing partner at SHAWKWEI and Partners. We're a general partner private equity firm. We invest in mid-market, industrial and service businesses in Asia, and that are working across North America and Europe. We have offices in Hong Kong, Shanghai, Singapore, and San Francisco.
Thanks, Carl. And maybe Kapil, you want to go next?
Hi, everyone. It's good to see you virtually. I am based in Hong Kong, and KKR has a large presence here. I'm on the legal and compliance team, managing compliance for Asia Pacific. We invest across strategies, private equity, infrastructure, real estate, credit, technology, 20 offices worldwide, 8 of them here in Asia. And it's really, really good to be with you all.
Johannes?
Yeah, thanks, Irene. Yeah, really excited to join this exciting discussion, this conference. My name is Johannes. I'm the global head of the private equity business at ALPHASIGHTS. ALPHASIGHTS is a global leader in knowledge on-demand services, so we help our clients make better decisions by connecting them with industry experts through phone calls or surveys or other means. We are a global company. I'm personally based out of our London office in Europe, but we have large teams in Asia across Hong Kong, Shanghai, Seoul, and Tokyo. And I think my relevance to this particular topic and why I'm excited for it is that we work with around 500 global VC and private equity firms and work for them on roughly 100 diligence or pre-diligence topics each day. So hopefully I can sort of provide some insights into what we've seen across that magnitude of projects over the last couple of years.
And last but not least, Sylvain.
Hi, Irene. Hi, everyone. Very nice to meet you all and to be on this panel. I'm Sylvain, CEO and co-founder of SESAMm. We're a company that provides AI and text analysis insights, especially at pre-due diligence stage, to private equity firms. We work with 6 out of the 10 top private equity firms worldwide and have an office in Tokyo in Asia. And we're a team of 70 people, so a smaller team, but really growing use of AI technologies in private equity. And very happy to be on this panel and to tell you a bit about some of the innovative techniques that exist to perform due diligence.
Great. Thank you very much. And as we've known, due diligence is a very critical component of the investment process. And pre-COVID period, there's a lot of on-site visits and also in-person meeting with the management. But during this COVID period, that is not possible now. So I'd like to turn to Carl with the first question, since that, what are the challenges that you face in this pandemic, and how has the process of the approach to due diligence have changed during this period?
Okay. Well, I think before COVID, we would spend a lot of time traveling. I think like most people in private equity, we would be looking for new deals. We would be conducting due diligence on those deals that we thought were interesting. and of course we would be managing our portfolio investments. And so there was a lot of emphasis, I think, during those days on the visit. And people would get together, there would be physical meetings, there would be presentations. And those visits were not that frequent, once a month, maybe once every 3 weeks. And you would be meeting with people and following up. I think after COVID, all the visits stopped. And probably initially, due diligence wasn't so much of an issue as it was just managing our portfolio companies. And the way we segued from the big visits where we would meet people on site was, of course, virtual meetings. And what we found is with virtual meetings, we could get a rhythm and a cadence where we would do them once a week. So instead of it being once every 3 or 4 weeks, you would be talking to people regularly, and we would be getting, in fact, perhaps more people in the room, and there'd be the opportunity for follow-up. And then I think this naturally evolved into a due diligence process as well. So again, instead of having the big meeting where you go on site and have presentations, you'd have a series of, well, in a due diligence process, daily meetings. And I think the way that we had to alter our behavior was whoever was on the physical location, of course, could visit that meeting, but then we brought more of our Hong Kong colleagues into the discussion. And so we got more of our colleagues who had been in the Hong Kong office to participate in those virtual meetings. I think the upside is that you're able to follow through more diligently. Items can be paced for immediate follow-up the next couple of days, and you get immediate feedback on what you're doing. I think the drawback to not visiting is I think there's some diminished creativity that oftentimes when you're on site and you see things, you get a much more complete picture of the operations, of the challenges, of the opportunities that the company faces, and that when you take away that visit, I think you do diminish your overall creativity on the deal. But I think net-net, it's possible to operate the way that we have been. I look forward to the day when we will be able to visit, but I do not think we'll go back to the sort of high level and high volume of visits that we used to do. It'll be some sort of hybrid where we visit less frequently, but we continue to have these very frequent virtual meetings.
Thank you, Carl. Kapil, do you want to add on to that in terms of how your approaches have changed during COVID?
The key message is the same. We used to be on site. I used to be on site with my team extensively, and there's no substitute for that. Seeing the business, meeting the people, building the relationships with individuals whom you're investing in for at least 5 to 10 years. What has come out of this period is a much more structural approach to diligence. We've had to sort of sit back and break down the asset, break down the target and say, okay, on the one hand, what are the strategic and the business risks that we can't get a sense of on site because we're not there? What do we need to understand about the business model? What do we need to understand about the country, the geopolitical risk? What do we know of the macroeconomic environment, which is quite volatile, at least in the last 2 years? We've had to be a lot more thoughtful around non-financial risks as well. And this is really driven by the fact that we're largely restricted to a desk-based approach. Do we understand how the target, for example, will manage business disruption? Do we understand how they are staying compliant with their local laws, policies, procedures? There are a lot of obstacles to doing business in this period, and those obstacles are likely to continue, and they will no doubt impact valuation. So to what extent are we being thoughtful around looking at their BCP and their business disruption? That sort of leads also then to data risk. It goes without saying that we are working extensively on laptops and emails, and to what extent have they thought about information security, hosting, transfers, and the laws associated around that? COVID has also brought to light the need to diligence people, diligence health and safety, even diligence employee retention, all really important, irrespective of industry. I think the other areas that we've traditionally sought to diligence compliance, such as AML, anti-bribery, anti-corruption, those were always desk-based, and they can still be desk-based. You can do your accounts walkthroughs, you can do your whistleblower testing remotely. But I think there is now a need to see whether all those processes still work. They haven't been interrupted by the current environment. The last point I want to raise is just that diligence has had to sort of break into two ongoing areas, and that's being mindful of the internal factors at the business and the external factors, which they have no control over. And COVID has proven that business has to be resilient. There are factors they cannot control, but there's still other risks, natural disasters, vendor errors. So third-party vendors with whom they've contracted in other countries, obviously facing a very different environment, potentially. There's been a lot of economic policy changes. The need to diligence and understand all of this and the impact on the business has really become a priority for our teams. And I think it's no longer just understanding revenue generation, understanding management and the C-suite. It's really getting to grips around the business in its entirety and how it will operate and deliver for your LPs on a go-forward basis.
Yep. Thank you, Kapil. Maybe to add on to that as well is that given all these additional things that you look at, do you also see that the time for due diligence has also lengthened as well during this period as you do remote kind of due diligence?
The time to diligence has not lengthened, but the intensity has. And by that, I mean the numbers of people you're working with. Because you're not on site, those who are in country, you're relying on to be your eyes and ears. You've had to bring on third-party vendors in IT because they can test the cyber resilience of the business. You've had to bring on more lawyers because you need to vet policies and procedures that have been on hold perhaps for 6 months because the plant hasn't been operational. You need to do perhaps more forensic testing because in a good environment, people are inclined to act the wrong way, and in a bad environment, they're even more inclined to act that way. So there's certainly more engagement with the Big Four. As is stating the obvious, FCPA liability can be incurred from books and records deficiencies. So that's where we're spending time with accountants, auditors, a lot more than we would have perhaps in the past. So I think the intensity is up, but the time frame is the same. The opportunities remain competitive, and the window for us to make a go, no-go decision remains the same.
Mm-hmm. So for Carl, is that same for you too as well?
I would say I think the due diligence process is lengthened. I think that there is a certain slowness to having these virtual meetings and people reporting back, and there are more people involved because it's possible for more individuals to join a virtual meeting. But I think it does, as I alluded to earlier, I think not visiting the site, not having the sort of immediacy of seeing things and putting two and two together and understanding how the business is driven, it drags out that discovery process and takes a bit longer. So I think you can still get there at the end of the day, but it does take longer in my estimation.
Mm-hmm. Okay. And for Johannes, maybe moving to you, is that do you see your clients approach due diligence differently during this period?
Yeah, I think some really interesting points made here. I think from our side, I would actually say that we feel that the intensity and the speed at which the processes seem to be moving, or at least the speed at which our clients are sort of demanding service of us have increased quite dramatically, actually, as we see things. Just to give you maybe a couple of numbers here, I think maybe 3-4 years ago, it would be fine for us to deliver an initial list of relevant experts within, let's say, a day or two, where now sometimes if you're not within a half an hour, sort of get back to your clients, they've already moved on. So I think in our industry, I think from where we look, I think the intensity and the speed has really gone up, in particular, I think in the sort of, let's say, more competitive parts of the market, sort of the growth equity markets and the larger buyout markets, which are the main users of our services. So I think that's really one big trend we are seeing. And then also I think, as Kapil said, I think the scope of diligence has broadened, and I think the volume, therefore, for our services have gone up, I think, quite sort of drastically as well. I think we obviously sort of, I think, again, to share some numbers there, we obviously are steadily growing business, but we have nearly tripled in size now in the last 2 years. As I think the need to do more outside in diligence and sort of get additional perspectives has become even more important, as you can't be on site and you can't maybe make your call or judgment that way. So I would say those are probably the two big trends that we have seen. I think echoing mainly, I think also some of the points that Kapil had made.
Yep. Great. Sylvain, do you have anything to add to that in terms of how your clients has approached due diligence differently?
Yeah, there are a couple of things. And first, to echo some of Kapil's comments, I think non-financial risks have become very important in the process. We've all seen ESG growing as a topic, including at pre-diligence stage. And same for digital risks, in the sense cyber attacks, resilience of IT systems, etc., but also risks related to consumer reviews, mentions, employee evaluating their business and potentially leaving, etc. So I think there are new risks that have emerged that people are looking to evaluate as part of the due diligence process. And just to give you a bit of context, our specialty is screening web data and extracting insights from it using natural language processing, so using text analysis, and using these insights in combination with expert networks in order to find pre-due diligence insights, so really at the early stage of the commercial due diligence process. And for that phase specifically, we have seen a much faster turnover time, especially as a lot of firms are looking to preempt rounds and are looking to get more intel earlier on in the process. So I think for that specific phase where you want to get as much 360 view of the company, it's actually faster than before. And the part of the process that you are mentioning, where it may be more lengthy, maybe also in the next part, but I think that people want very, very early information. And for us, typical example are the company comes to us and they are looking to, let's say, screen a beauty business in Hong Kong, and they want all consumer reviews and understand the company's e-reputation, and they want to understand the main themes and the drivers of the market, and that needs to take a few hours to a few days rather than weeks and months of work by a consulting firm. And I think this is also why some of the services like ours, which are AI driven, which are automated, etc., which rely on algorithms to extract insights, are emerging more and more in the market. So yeah, definitely kind of an acceleration on that due diligence side in order to make processes more efficient and to account also for increased competition that we've seen in the market in recent years.
Okay, great. And as the situation of the pandemic improve as well, so as mentioned, site visits and on-site meeting with management is still very challenging. So we also seeing technology being used. So you mentioned about video conferencing and stuff like that. So how have your firm actually adapt to this technology, and how do they does your system upgrade to satisfy the remote of this contact?
I think the first trigger point for us with technology has been within our portfolio companies and pushing them to upgrade their ERP standards and their systems and their practices. And so that's been something that we've worked on for years with portfolio companies. And then I think as a spillover effect from the shortage of labor that we've seen the last couple of years across Asia, we've pushed more into automation as well. Before COVID, we had challenges with rising labor cost. With COVID, we had just simply shortages of labor. And so that drove an increased awareness and acceptance and adoption of automation. And so when you bring those two together, better ERP systems, more automation, what you find is you're getting a lot more data generated out of the business. And that data is everything from, input prices to process times to output yields. And with that data, I think you get a whole new set of reports that you can monitor and evaluate for how the business is performing. On the private equity, on the GP side, how we've embraced technology has been, I think, less forward-looking. It's been Teams and Zoom calls. It's been, cameras within our facilities and sort of being able to watch what's going on and doing virtual tours of the facilities. I think probably the next phase for us will be taking that data that we're getting out of our portfolio companies and running it against other portfolio companies, running it against peer groups, not just having only the financial analysis, but also a deeper dive on data analysis that's generated from the businesses. And so I think that's something that I look forward to.
Mm-hmm. Okay. And for Kapil, how about yourself in terms of technology on your end of the business for your firm? How does that work for your end?
The point made earlier around having more data is spot on. Basically, if we take a few examples, cybersecurity, data privacy, money laundering, bribery and corruption, because of all of the information we're receiving on a desk-based basis now, we've actually sought to implement testing programs at our portfolio companies and internally that we can monitor so that we make sure that the standards that we would expect our target companies to operate at are actually adhered to. Mm-hmm. So we've instituted a much more automated process which has a regular request, for example, for documents that will show us they're updating their compliance policies, that they're updating their training materials, documents that will screen for litigation or negative press. A lot of the technology is running these requests and searches automatically because we have now so many automated resources that have become available to us post-COVID. I think also what's really important is because of our inability to do site visits, we need to have some type of constant overview on the compliance, legal and compliance infrastructure at our businesses. And what that means is we will have automated testing, gap analysis, requests will go out for information that'll feed into some of this testing, and then it'll automatically feed into our law firms, our internal legal and compliance department, so that we can keep abreast of the portfolio. We obviously can't do all of the companies at the same level, so very early on we're risk rating the companies based on the jurisdiction, the infrastructure, the size of our investment, whether or not control, non-control, whether or not we control the board, and that determines the frequency with which these automated requests for information are being sent out. So I think all in all, there's no doubting there's been an increase in technology. What we would have done on site, visit the portfolio companies, actually have them show us how they're running, has become automated. One thing I would just flag that hasn't become automated and cannot become automated is that colloquial tone at the top. The C-suite drilling down that this is the right way to do business. this is how we need to adhere to doing business. That message cannot come in an automated fashion. That requires personalized messaging. That requires personalized reach outs. It requires those division heads to actually spend time with individuals, even if it's through Zoom or on the phone or an email at worst, but making sure that the ethical standards and the tone doesn't get lost in all of the automation, which can get quite vanilla, as you can probably imagine.
Mm-hmm. And both you, Carl, also talk about the data, the big amount of data and the data analytic that you're going to do on your portfolio companies. How do you ensure about the privacy of all this data?
Yeah, that's a great question, because I think that as we collect more data and process it, we need to be very cognizant of data protection, both at our SHAWKWEI level, at the GP level, but also at the portfolio company. Because again, with this data, we're probably looking to share it. For example, in our portfolio companies, the data that they collect can be used to help them in marketing, going to the customer, explaining to them about how their product's made and how they could get more benefits from using our portfolio company. And so there is going to be a natural avenue for sharing information that we collect with a wide number of participants. Protecting it is going to be so important in a world in which data privacy is fairly low, actually, when we think about it.
Okay. How about Kapil?
Internally, we now have information security, cyber technology specialists within legal and compliance. So they are actually helping manage the data. When we work with any of the service providers, there are cyber risk assessments done as part of the vendor onboarding process. From a layman's perspective, which is the only perspective I can describe it as, it's throwing everything at the system to make sure it can't be hacked, data can't be stolen, and definitely the system can't be locked where we're in a position where we can't access it. So the vendor onboarding procedure has been expanded to include this testing by IT professionals who are sitting within legal and compliance and are dedicated to making sure that the software, the platforms, the vendors, and the data, therefore, that is being held on our portfolio companies, even our LPs, is secure. So there's definitely a large investment in both physical infrastructure as well as people infrastructure in this area.
Mm-hmm. Yeah. Now move to Johannes. Maybe touch a bit about how your services has also adopt technology, or how has your client adopt technology from what you see?
Really interesting topic, and one that's sort of very front of mind for us. Even though we're obviously a services business and in the business of connecting people, ultimately, I think our biggest investments actually the last couple of years have actually been on the engineering and data side. We now have nearly 20% of our organization sit in our engineering and data teams. As you can imagine, if you're trying to deliver that high volume and sort of quality of service at speed, you need a lot of data and technology to back that and empower the teams to doing that. So it's actually very front of mind for our business, even though these services we don't offer them to our clients directly. I think it powers a lot of what we do every day. So I think it's very front of mind for us at ALPHASIGHTS. In terms of what we've seen for our clients, I do think that as I think both Carl and Kapil said, I think our clients are definitely much more focused now on sort of how to, on the one hand side, make the most of all of the data available now, but also how to do that in a safe and secure way. So I think we've also invested a lot in our cybersecurity standards, have hired sort of massively on that team, and working with our clients very closely on how to best manage those processes and how to sort of use the data in the right way. And I would fully support what Kapil said. I think it's a combination of the right processes, the right technologies, but probably equally important is the culture and tone set from the top, and making sure you have a very strong culture of compliance and you explain to people ongoingly why that's important and why it's important to do the right thing. And I think that's sort of our approach to the topic. I think the combination of using technology in the right way and making sure you have the right culture and tone set from the top.
Mm-hmm. Sylvain, you have anything to add on that?
Yeah, sure. And it's an interesting topic for us. Our specialty is not really on the digitization side, so we don't see that change happening so much in GPs, and we're focusing a lot more purely on what's about data analytics, artificial intelligence, etc. And I can tell you that a lot of things are moving in that space for GPs. And just to name a few, for example, we have a close relationship with Carlyle, which are using a ton of data insights on the due diligence process, like I described before. There are great firms like EQT that are leveraging more and more AI with their tools, Motherbrain, in order to incorporate that in the sourcing process, generating data on millions of companies, rating them, scoring them in order to detect the best potential targets and to source deals. We also see a lot of things happening in terms of portfolio monitoring. To give you an example, we have a project where we track 5,000 private equity and private credit clients for a large GP in the US, and automatically generate ESG alerts based on media monitoring, both traditional and social media monitoring, to identify any potential environmental, social, and governance risk in real time. So these types of initiatives that are really data-driven, there are a lot of things happening right now, and we see more and more internal data science team, data engineering team, cloud computing teams that are being developed at GPs, and which are really helping promote that data-driven approach beyond digitization and automation, and towards really augmented investment, in the sense trying to leverage data in a way that is not just replacing or complementing what was done in the past more manually, but really goes beyond that with insights that were not accessible to human beings. And I find this super exciting. There's a ton of research on the corporate side, but even academic research going on in that space. Another very cool example is Unigestion, a very quant firm in capital markets that is now publishing paper in private equity to do real forecasting and prediction of deal quality and deal outcomes. And that's the kind of academic research that is really pushing innovation in this space. So lots of things happening also on that side beyond digitization, and that is very exciting because it represents also part of the future of this business.
Yeah, great, thank you. And Carl, just now you did mention about how when you look into your portfolio companies, you want to implement technology into them as well. So going forward, would you look into this kind of digital transformation in terms of your portfolio companies? Because as COVID has progressed, I think a lot of the industries have actually accelerated the digital transformation. So they want to increase their competitiveness and source. So going forward in terms of your sourcing, would you look for this kind of technology edge in terms of companies?
I think we want to identify what is the technology edge of a potential investment when we do due diligence. If they don't have it, that's an opportunity. It's an opportunity for us to bring a digital edge to the company. And so I think that's the key here, is that due diligence is both art and science. We've talked a lot about the qualitative side, data analytics, using outside experts, all of which are necessary and are valuable. But the qualitative side is equally, if not more important. Understanding, what is the investment thesis of the deal? What is the risk and reward? And so when you look at a company that has an absence of something, there's an opportunity for you to bring it. So in the case of let's say, maybe an older business that's still founder managed. They lack an ERP system because the founder just knows everything about the business and he runs it in his head effectively. Well, that's not something that you can build going forward. You can't replace that. And so ERP and technology become very important drivers for understanding and managing the business going forward. So I think for us, we see technology as a tool, as something to augment the years of experience that we have in managing investments, in looking at new deals and thinking about the risk-reward trade-off, and effectively what really the LPs want in a good GP, which is that subjective analytical capability to augment what is the quantitative side as well.
Great. We've talked a lot about what have the approach to due diligence have changed during COVID. But I guess maybe a bigger question is that how has some of the key considerations that have happened over the years? So I know there's a lot of talk about ESG, a lot about cybersecurity as well. So maybe hear a bit from Kapil in terms of where do you see in terms of the extent of the due diligence change over the last few years?
I think that the due diligence changes are very much driven by the regulatory environment in which these businesses operate. A lot of them obviously now need to adhere to different forms of reporting. So what's happening is traditionally you would just see remediation plans in place to enhance the effectiveness, efficiency of the business, but very much now regulators are driving the expectations and they want to see clear disciplinary procedures outlined and practiced. They want to see periodic testing of compliance policies and procedures. Legally, they want to see appropriate resource allocation. They want to see employment protection. They want to see supply chain risk managed. So I guess the answer to your question is really what is going to come out from the local legislatures, what's going to come out from some of the leading regulators in the world, SEC, FSA, SFC, because they're the ones that are now driving very much what GPs need to be cognizant of when they look to diligence and make investments. ESG as well, it's extremely broad and no doubt extremely talked about. I know there are a lot of specialists and there's an entire segment of AVCJ that's dedicated to that. I will just say that the more prescriptive the regulators get in their reporting requirements on things like ESG and cyber and technology risk, the more prescriptive our diligence needs to be to answer those questions. It's pretty imperative that we maintain our license to make these investments and we maintain the licenses of our businesses. So we have to deliver on what the higher powers ask of us.
How about Carl? Do you have any additional considerations?
Well, on the subject of ESG, I think there's two reasons that drive us. One is it's good business, and secondly, it's good for the subsequent sell of the business when we want to exit it. So what's good for business is to take care of your employees, to make sure they're safe, to make sure that they work in a healthy environment and that they're treated fairly. It's good business to embrace ESG standards because the customers of our portfolio companies want that. It gives you an advantage, and you're at a disadvantage if you can't meet the standards of international clients. In terms of the exit, it also makes a lot of sense. If you want to sell the business to an international buyer, you can be sure that they're going to be concerned about things like environmental degradation. Is your facility polluting? Is there any sort of toxic byproducts that somehow are on the properties either today or in previous locations that you had it. So therefore, it drives us to think about all those things when we invest. What is the ESG standards that the company has? And if as long as they're at an acceptable level, we can maybe then take them to a higher level. I mean, if there's egregious violations, those may not be reputable at all, and so we'd pass on the deal. But I think, rather than looking at it as something that's mandated by the government, we view it as an opportunity, much like decarbonization and renewable energy. They're good for the environment, but they're also tremendous business opportunities for companies that can provide a pathway to a decarbonized world and cleaner energy and safe energy.
Great. We have some questions that come through from the floor, so I'm just going to ask some of them to the panelists. So Sylvain, this is a question for you. Please explain how your company uses AI to help firms conduct due diligence.
So on our side, what we do is we have a database of around 16 billion articles and messages, including consumer reviews, developer comments with regards to IT solutions, web traffic data, employee reviews. And we can screen these contents automatically in order to address questions. So same as with expert networks or same as conducting a commercial due diligence with consultants, it helps address questions very quickly. And it's things like a private equity firm comes to us and they want to explore the e-reputation of a company, see whether people are more happy about the product than their peer group, compare the growth of companies together, identify any potential red flags, but they want to do that in a highly automated way, and they want to do that in a matter of a few days rather than in a matter of weeks. And so we read all of these contents automatically using algorithms in multiple languages, including in Mandarin, including in Japanese, and we translate these into analytics, visualizations, and reports to really give that 360 view to the business. And to be very precise, it takes around 3 to 4 days to deliver 40 to 50 slides, where we really give a full due diligence on a company without having any access to the data room, based only on public and premium sources that we can find from web data. So that's really our methodology, and that's how we bring these due diligence insights. And we do close to 200 of these per year, and especially to accelerate the initial stage of the process and give very statistical insights that are relevant to assess the strengths of a brand.
Great, thank you. Another question is that for the panelists actually, is that what's your view on the strength or the merits of investing in in-country resourcing and the capacity of in-country staff in relation to due diligence, which has changed from where it stood 2 to 3 years ago? So I think we mentioned about doing remote due diligence. So what do you think are the merits of having people on the ground? So maybe Carl, you want to touch on that?
Well, I think having people on the ground is very important. I think it's most important, though, to have people who are experienced in due diligence, right? So just simply having somebody who's there isn't really good enough. You need someone who understands the due diligence process. You need to have someone who knows how to work with your due diligence team, meaning internally. And then, of course, there's the oversight of the various third parties we outsource, whether it's accountants, tax authorities, or tax experts, consultants, lawyers. So I think having that due diligence expertise is a unique capability, and I think it's a very valuable one. But it would be great if we had them in every country we invest. But we invest in probably 30 different countries, and so that's probably not practical.
Okay. So you have it in your core countries, and then
correct, yes,
engage maybe external helps on that.
Yes.
Okay, cool. How about Kapil yourself?
Hugely important. I'm a big supporter of in-country resources. If we sort of tie the challenges that we're looking at today, say ESG, you really need a local specialist to understand supply chain risk, to understand community relations, to understand privacy challenges, to understand health and safety. So it's even your consumer welfare, your interaction with local regulatory bodies. It's very advantageous to have someone that you like and trust on the ground, who speaks the local language, who speaks the local culture. And that speaks specifically to Asia, because it is certainly not the United States of Asia. The cultural and business nuances come through your local staff, and they will tell you this is how it needs to be communicated, addressed. This is where the investment needs to go into if you're looking at a diligence risk. So Kyle's right, you can't have 30 offices. You've got to manage your expenses, but there are strategic places where you can certainly invest in good people.
Yeah. We have about another 1 minute, so maybe Johannes, you want to share your view on this one? In terms of you covering different countries, how about having more resources in those countries?
Yeah, I think very similar thoughts to Kyle and Kapil. I do think we find it hugely important to have people on the ground that understand the local nuances, local culture. So while we, for example, only have 2 offices in all of the Americas, we actually have 5 offices in Asia because the nuances are I think, much larger. And I think it's hugely important to be on the ground and understand